Hi, it's Jason Solomon and Scott O'Connell. Today's topic is going to be charitable remainder trusts. And before we jump into it, as usual, these videos are educational. They're meant to help give you some ideas, but do not go out and implement a charitable remainder trust after watching our video. You can talk to our team, you can talk to your team. So here we go. Charitable remainder trust. Charitable remainder trusts are irrevocable trusts, and they're really made for two different groups of people. One is some family or person who is charitably motivated, and another group are people who have highly appreciated assets. Could be anything. It could be stocks. It could be real estate. It could be businesses.
Charitable Remainder Trust, or CRT, is an irrevocable trust where it has its own tax ID, meaning that the assets inside the trust are not in your name. They're not in your estate, which could be beneficial in the future when it comes to estate taxes. But when you move an asset inside a CRT and sell that asset, you eliminate the capital gains tax on the sale of that asset. Now, what assets could it be? It could be stock, it could be real estate, it could be a business. So the immediate impact is that you do not pay capital gains tax on the sale of that asset because that asset is inside the trust. Now, once the asset is inside the trust, you must start taking income, and you can take income from that trust either for lifetime for you and your spouse, or you could take it for a period of years, up to 20 years. You also will receive charitable deductions on the sale of that asset inside the trust. Once you move the asset to the trust, you get charitable deductions. And then when you pass, that asset inside the trust will be passed on to a beneficiary. That beneficiary could be a family foundation, it could be a charity of your choice. But that is how the Charitable Remainder Trust works. And who's it best for? Well, initially, the immediate impact is for those that are selling a business, a highly appreciated business, highly appreciated piece of real estate. Because as mentioned, you avoid the capital gains tax, which could be, upwards of 30, 35, even 40%, depending on the state that you live in.
20% for high-end capital gains, plus that 3.9% surcharge. But then if you tack on a state income tax on top of that, you're right, you're getting close to 37%. So people who have highly appreciated assets and they put them inside a charitable trust long before they're going to sell, once they sell that asset, there are no capital gains. It's not just for avoiding taxes or delaying taxes. It's also for people who are charitably motivated. You may be someone who doesn't have children and you want to leave all of your assets to a particular charity. Well, if you wait until you've passed away to leave those assets to charity, you don't get a benefit. But if you move those assets into a charitable remainder trust right now, two things are going to happen. Number one, you're going to get an income stream for the rest of your life, and if you're married, your spouse's life. Second thing that's going to happen is you're going to get a charitable deduction for moving those assets into the charitable trust.
But the long-term benefit is two things, really. Number one, it removes that asset from your estate. So if estate taxes is a concern for you, and I know the limits of the estate tax are subject to change, may change, but if the
constantly changing, right?
Yeah, they're constantly changing, and by the looks of things, they're going to be reduced over time. For instance, the estate tax now for a married couple is close to $27 million total, $28 million total, meaning anything over that, when you pass away, your heirs, your beneficiaries, will be taxed at 40%. They're set to cut that in half in about a year and a half in 2026. Now, whether they do or not, we'll find out. But over your lifetime, that could still be reduced. And so if estate tax is a concern, having an asset out of your estate, out of your name, into a trust is beneficial. The other benefit too is that you leave a lasting legacy. How do you do that? Well, you get to set up your own family foundation. You get to choose what charity will be the ultimate beneficiary.
How many people do we know? I've been doing this since 2001. And how many people or families do we know where mom and dad saved or they built this large nest egg, whether it's a million, a half a million, or 30 million, and they pass away, and all of a sudden the kids come into this wealth? What we know in our experience, it's not every single situation, but the majority of situations is that when kids receive a large sum of money, they're going to go spend a lot of that money. That money that you were saving, that money that you wanted to last for generations in the future, and it goes to a Mercedes or it goes into an expensive house. And although your kids still may have that benefit if you have a trust like this and it moves into a foundation that they're in charge of, they're never going to be able to grab that money and spend it all.
Yeah, so for CRTs, there are short-term benefits and there are long-term benefits. The short-term benefits is that you get to reduce or eliminate capital gains tax on the sale of the appreciated asset. You also get to receive charitable deductions, which you can use for future years, which can help offset some of your income. But the big bang, too, for this is that the long-term benefits of a CRT is that you get to create generational wealth. And what do I mean by that? Well, as we mentioned, there has to be a beneficiary in place when you pass with a CRT. And that beneficiary can be a charity, it can be a foundation, it can be a family foundation, something that you set up where your children and grandchildren can receive payment for running the foundation. And this money can last for generations. So one of the problems that we see with our clients, not problems we see, but problems they come to us with, concerns they come to us with, is that they've accumulated a large sum of assets, okay? And the first thing they say is, well, we want to pass this on to not only our kids, but our grandkids and maybe even further generations. But we're afraid of two things. Number one, we're afraid of taxes being taxes cutting possibly in half the assets, 40% or 50%, depending on the state that you live in. And we're also concerned that our children may just spend the money or use it unwisely, because a lot of generations, a lot of people just think of their lifetime. But if you're setting up a CRT, you're thinking of the lifetime of not only you and your children and your grandchildren, or even a charity. So you're thinking a wider scope of benefits, which is more of a long-term effect.
Yes, so a charitable remainder trust, the beneficiary, as you mentioned, it has to be a 501c3. Has to be. But that 501c3, it could be Ronald McDonald House or it could be the O'Connell Family Foundation. And if it is that family foundation, as Scott was mentioning before, your kids can receive a salary for being on the board of directors of that foundation. They have a job that's worthy of compensation, and that job is to distribute 5% of the foundation every year for the charity so that they can get paid on and on and on and on without you having to worry about family members taking a large sum of your wealth that you built and wasting it.
Yeah, so if we start with using a CRT versus not using a CRT for the sale of an appreciated asset such as a piece of property, if you sell a piece of property for $1.6 million, let's say, okay, you're going to pay taxes on the sale of that property up front. And those taxes will be a combination of possibly capital gains tax, depreciation, recapture, net investment income tax, and state tax. So in this example, we're using California as a state, and I know that's a high state tax, but the taxes that you would pay in that $1.6 million sale would be just over 37%. So your net proceeds of a $1.6 million sale would be $994,000. Now, if we compare that with using the CRT, as we mentioned, you avoid those taxes up front because the asset is already in the trust. So the value of that asset remains $1.6 million. Now you have to start taking income from the trust. You have to start taking income from this at a minimum of 5%. So we're going to use 5% in this example. So as you can see, there's a difference in net proceeds between using the CRT and not using the CRT. And when you take income from that difference, using the CRT, your annual income at 5% would be $80,000 as opposed to $49,720 if you didn't use the CRT. Now, if we fast forward over 30 years, well, the benefit exceeds $2 million.
Let's take a look at another case study. And in this example, we're going to use John. And John also lives in California. He sells his business for $30 million and doesn't use a CRT. He'll roughly pay $7 million in federal tax, $4 million in state income tax, which means he'll be left with about $19 million after taxes. So John will have taxable income at 5% from his $19 million of $950,000 a year. Where Judy, who's in the exact same situation, lives in California, sells her business for $30 million and uses a CRT, she's got $30 million that she gets to invest inside of her CRT. And so her $30 million will generate $1.5 million of income per year, an extra $550,000 of income per year. The reason she gets to do that is because she's not paying the capital gains tax on the transaction. Sale of that business, she's going to keep the full value because she sold it inside of a CRT.
Yeah. So in summary, a CRT has many benefits. You save on capital gains tax up front. You receive charitable deductions. You get the asset out of your estate. Okay, so for estate tax purposes, the asset is no longer in your estate, which will help as those estate exemptions decrease over time. And you also get to pass that money on to your own foundation or your own charity. So you're leaving a legacy. Charitable Remainder Trusts, though, they do have some restrictions. They do have some things that you need to be aware of. Number one, when it comes to CRTs, is that it's irrevocable. So once you put it in the trust, you can't change your mind later and then decide to pull it out.
So you're going to be restricted to taking income streams for the rest of your life.
Right. And you have to be aware of UBTI, which is unintended business income. That can affect how the trust is treated for tax purposes. You also can't be living in the property that's in the trust. So if you move a piece of appreciated property or real estate in the trust, living in that property is not a good idea. And the last thing too is S corps. If you own an S corp, you really don't want to have the S corp or can't have the S corp inside the trust as the asset that's inside the trust.
It's really important that you mentioned S corps because a lot of people have S corps and they're making $1, $2, or $3 million a year. They're really not getting a lot of benefit from that S corp, and they're also limiting what they can do, including using a charitable trust for their appreciated S corp.
The benefits and the restrictions, those are just some that you need to be aware of before you make a decision. And again, this video is not designed for you to run out and set up a CRT, but it is designed for you to have some thought and to consult with your professionals, your tax professionals, your financial advisors, and see if this is something that may be of benefit to you and your family.
Last thing we'll do here is we're going to go through the process of what a CRT would look like for somebody. Scott, I'm going to use you as an example. You have this business, it's flourishing, you're crushing it. You've got a business that you're about to sell for more than $30 million. Well, the first thing you do if you meet all of the criteria is you need to move that business into a charitable remainder trust. You could use part of the business or you can use the entire business. Once the charitable trust is established, once the business is inside of it, the next step is to find somebody to sell your business. So you'll want to reach out to a business broker, list the business for sale, place the sale inside of the charitable trust. If you've done those things properly, you're going to avoid the capital gains on the sale of that business. At that point, the charitable remainder trust becomes your income stream, you and your spouse or significant other, and you're going to receive a minimum. You're required to take 5% from the charitable trust for the rest of your lives in most cases. When both of you pass away, the assets are going to go to a 501c3, a foundation, whether it's your private foundation or whether it's the Ronald McDonald House or whatever foundation that you choose, that's where the bulk of that money is going to go. And then there's different ways if you have your own foundation of how your family can be in charge of that foundation. You'll want to set up an irrevocable life insurance trust. Scott, can you speak to the irrevocable life insurance trust for everybody?
Yeah, an ILIT or irrevocable life insurance trust is a life insurance policy that's inside a trust. So therefore, the first thing you have to understand is, again, it's not in your name, it's not in your estate. But the benefit of it is to your beneficiaries is that they will receive, after you pass away, they'll receive the proceeds of the life insurance policy tax-free. So remember, a lot of what we're talking about obviously revolves around taxes and trying to benefit your beneficiaries in the most tax efficient manner. And so an ILIT or irrevocable life insurance trust is designed to put a portion of your income or portion of the money that you have currently into a life insurance policy so your beneficiaries can receive that money when you pass tax free, number one. And number two, it stays out of your estate for estate tax planning purposes.
Perfect. Well, that's going to summarize our talk about charitable remainder trusts today. We look forward to sharing more videos with you in the near future.